We have the past picks of David Burrows here. He's the president and chief investment strategist at Barometer Capital Management. Harking back to April 9th of 2013, you recommended Keyera. This one's up by a third. And again, back to this energy infrastructure theme.
Yeah, so Keyera is a top 10 position in the firm and likely to continue for a while. Company obviously is in the infrastructure business for energy. They've done a great job of building out both the infrastructure and marketing business, where they're stripping NGLs out of the petroleum and remarketing it.
Right,
to
natural
make a
gas liquids.
Yeah.
Yep.
And they continue to have investment opportunities to build out new infrastructure going forward. So this is a company that's going to continue to grow its dividend. We think it's a very predictable asset. They don't have a lot of commodity price risk. And it's one that we would continue to own. So we've owned it for 3 to 4 years. Again, one of those ones, hard to stay in a winning position. When we entered the group, just to go back though, we look for groups that have gone out of favor for some period of time, where we see new net buying or where we see numbers that point to something changing for the better. So you can not only get improving earnings numbers and cash flow numbers, but you could get an expanded earnings multiple versus the rest of the group. And this has been one of those companies, and think that this can continue for a while.
Next up, you recommended Merck & Co., the pharma company in the U.S., MRK, higher by 35% since then, including the dividend.
Yeah, so about 18 months ago, pharmaceutical went from a group universally hated to slowly coming back into favor. And for the same reasons it was disliked, being sort of boring, low growth business, this is a company that has now shown to have very durable cash flow, very predictable assets, and this whole industry has been restructuring and showing great cash flow. So if you think about what investors are looking for, predictable cash flow, good dividend policy, strong balance sheet, this company fits into the camp. What we are seeing now, though, is script growth across the pharmaceuticals industry and biotech industry, partly because of this Affordable Care Act, makes it very attractive. The second thing that gives us probably more confidence is that we're now seeing activist shareholders step into pharmaceutical that have never been in pharmaceutical before, recognizing the value of these balance sheets. And we think that that could give investors more confidence, because you're seeing some premiums paid. We're seeing mergers and acquisitions take place. And we think that this is going to continue. So we entered the group as it was an unfavored group, but starting to see new net buying. And then now the hard part is just staying in it. And we think that there's great attributes in Merck.
Speaking of pharmacy benefits, that brings us to your other past pick last April. It was Walgreen. You're higher by 47%, or at least the stock is, but you're since out of it. When did you get out and why?
We came out partway through last year, and frankly, it's one of them we wished we didn't come out of. The original reason for buying it was that we felt that the Affordable Care Act would increase the scripts, which is happening. They had done a deal with Alliance Boots to buy a bunch of stores, which was going to provide them with a tremendous synergy, cost savings. And in the most recent quarter, guided the synergies up. In other words, they're getting more benefit from the cost savings than they had expected previously. We just have been moving to somewhat more economically sensitive sectors. This is a little bit more of a defensive sector. The stock's acting great. You know, there's absolutely no reason why we couldn't own this today. It's a great business with good changes taking place. They've had a 5-year dividend growth of just over 23% a year. So if you can get a close to 2% yield that's growing double digits, again, why wouldn't you want to own that versus a treasury bond at 2.6% that will never increase what it pays you?
Mm-hmm. And just 30 seconds, if you could, on back to pharma. Is it sort of a domino effect? You get one deal, then you see a whole bunch?
Well, I think that what's happening is that corporate investors are much like individual investors. If you go through a period of time where you're a bit shell-shocked, you're very cautious. But as you start to get more confident in the future, you start to be willing to take more risk. You know, Alan Greenspan, I saw interviewed last night on another outlet, and he talked about the fact that his view was the biggest problem in the U.S. right now is that corporations have been investing in short-lived assets, not willing to make long-term commitments.
Right.
And we're starting to see corporations make longer-term commitments, like mergers and acquisitions and things.
Right, and it looks like Pfizer wants to buy AstraZeneca for as much as $106 billion, to David's point. And we'll come right back with more questions for David on North American large caps after this.